everyone, welcome to all of you in a new section of our YouTube channel MS Commerce classes. In the last lecture, we discussed about the meaning of the financial statement and the nature of the financial statement. I hope all of you visit in this lecture. If anyone missed this video, then please check this video. In today's lecture, we discuss about the objective of financial statements. We just first revise the meaning of financial statement. What is financial statement? The financial statements are the combinations of position statement and income statement. Position statement means that is the balance sheet, and the income statement means that is the profit and loss account. The combinations of both is called financial statement. And today we discuss the objective of financial statement. Actually, what is the object of financial statement? Why we prepare financial statement? The financial statements are prepared at the end of the accounting period. Yes or no? Object of financial statements is, we discuss the objective of financial statement. The primary objective of a financial statement is to assist the decision making. Why? It is the main aim, the main objective of the financial statement is decision making. The financial statements are the sources of information on the basis of which conclusions are drawn about the profitability of the financial positions of a concern. Actually, these financial statements are prepared at the end of the accounting year. At the end of the information collection, we prepare the accounting statement or profit and loss account, balance sheet. These financial statements are the sources of information in the basis of which conclusions are to be drawn, which will be profitable for the business. In there, the Accounting Principles Board of America, APB, Accounting Principles Board of America, provides some objective. The first one is to provide the reliable information about the economic resources and the obligations of the business firm. The financial statements provides the information regarding the economic resources. It provides the information regarding the economic resources, and it also provides the other needed information about the changes in such economic resources. It also provided the needed information about the changes in the such economic resources and the obligations, and it provided the reliable information about the changes in net resources arising out of the business activities, and it provides the financial information to the assist of in the estimating of earning potential of the objective. Overall, the objective of the financial statements is that the financial statements provide the information to the economic resources where the economic generated where the economic generated. This information should be provided by the financial statement. The next point, to provide the other needed information about the changes in economic resources, in which resources it should be changed. These are these informations are provided by the financial statement. And the next point says to provide the reliable information about the changes in net resources arising out of the business activities. In the overall business activities, all the changes of net resources are to be provided by the financial statements. The net resources are to be provided by the financial statements. These are the some basic objective of the financial statements. And the statements demonstrate the effectiveness of the company's management. The statements demonstrate the effectiveness of the business management. As well, these financial statements will be helpful for the company's management. Why? It will be provided the particular information which is needed for the company. The another objective is they even help the readers of these statements know the accounting policies used in them. This will be help in understanding the statements of more comprehensively. When I prepare the financial statements, we follow some rules and regulations or we follow some policies of the accounting. When some reader read the financial statements, he can be able to understand or to clarify how it will be prepared, how all the policies are to be maintained when the financial statement is prepared. This helps in understanding the statements more comprehensively. It will be helpful to all, like of companies, management, creditor, investors. Everyone will be helpful on the financial statements. Actually, this financial statements is is prepared for benefit of the organization. These are the some basic objective of these financial statements. What? The financial statements provide the information regarding the economic resources, obligations, and of the business firms, changes of economic resources, changes of net resources. These informations are provided by the financial statements, and this will be helpful for the company's management. I hope you understand the objective of financial statements. In the next slide, we discuss the types of financial statements. Basically, there are four types of financial statements. Basically, there are four types of financial statements. What? Just a minute. Okay. Basically, the financial statements are divided into four parts. Of like one is balance sheet, income statement, statement of changes in owner's equity, and the statements of cash flow, which will be called statements of financial changes in financial position. Okay. Actually, the financial statements are primarily we called these are two types. One is the positional statement and another one is the income statement. The positional statement means balance sheet and the income statement means what? Profit and loss account. But according to the GAAP, General Accepted Accounting Principle, they divided the financial statements into four parts. One is balance sheet, then income statement, statements of changes in owner's equity, and statements of changes in the financial position. Then the first one is what? Balance sheet. I hope all of you know the meaning of balance sheet. Yes or no? What is balance sheet? The balance sheet is a tabular format or a tabular statement of the summary of the balances. Yes or no? The balance sheet is the statement, is the tabular statement of the summary of the balances, which will be debit balance and credit balance. When we prepared profit and loss account, after the preparation of profit and loss account, who prepared balance sheet? The debit balance and credit balance are to be taken in the balance sheet. Yes or no? Here, the balance sheet is the one of the three fundamental financial statements and is the key of both financial modeling of an account. The balance sheet is displays the company's total asset and how these assets are financed through either debt or equity. It can also be referred to the statements of a net worth or the statements of a financial statement positions. Everyone know the format of a balance sheet. It is a tabular statement. The left hand side is liability side and the right hand side is asset side. It is consisting of the equity, debt, and the capital, net profit, and the asset sides taking the long term asset, the term asset, what we call current asset, fixed asset. These are the constituents of a balance sheet. The balance sheet, I hope you all of you know the meaning of a balance sheet. No need of giving of extra explanations on balance sheet. The next types of financial statements is income statement. Income statement means we know it is the profit and loss account. Yes or no? How you calculate profit and loss of an organization? Everyone, it is the basic part of the accounting. Whenever you study in plus two or plus three, first year, second year, you all of you know the meaning of how we prepare profit and loss account, balance sheet. We just give a short tips about the income statement or about the profit and loss account. The income statement is the profit and loss account. The income statement is the profit and loss account. In the profit and loss account is prepared at the end of the accounting period. Actually, this profit and loss account is prepared at the end of the accounting period. Accounting period. The whole year transactions in the particular 1 year transactions are taken when we prepare the profit and loss account. Yes or no? In the profit and loss account, there are two sides. One is debit side, one is credit side. In the debit side, we posted the items which are the which are the our expenses. Which are our expenses? All the expenses are called debit item. Yes or no? And all the gains are our credit item. Everyone know how to prepare the profit and loss account. In the income statement is the owners is the one of the company's core financial statements that shows the profit and loss over a period of time. The income statement provides that the profit and loss of the organization of a particular period. Of a particular period. The profit and loss is determining by taking all the revenue and subtracting all the expenses from both operating and non-operating activities. Yes or no? Whenever the incomes are more than the expenses, then we find net profit. When the expenses are more than the income, then we find what? Net loss. Yes or no? The income statement is one of the three statements used in both corporate finance or including the financial modeling and accounting. The statement displays the company's revenue, cost, gross profit, selling and distribution expenses, and other expenses, and the income tax paid or the net profit. These are the prepared in the chronological order. These are prepared on the chronological order. When we prepare the income statement, we focus on those items. The income statements consisting of revenue, expenses, and profit. Okay. The next types of financial statements is changes in owner's equity. Yes or no? The statements of changes in owner's equity. We called there are four types of financial statements. One is positional statements, one is income statement, then statements of changes in owner's equity. Change statements of owner's equity. Owner's equity means the values of owners or the shares of owners. Owner's equity. The statements of owner's equity is the financial statements that present the summary of changes in the shareholders' equity accounts over a given period of time. In a particular period, what amount of shares are changed in by the shareholders. The statements of owner's equity is the financial statements that represented the summary of changes of the shareholders' equity, the changes of shareholders' equity of a particular period. The statements of owner's equity helps the users of the financial statements to identify the factor that caused a changes in owner's equity over a accounting period. In a particular accounting period, the changes of owner's equity will be affected the financial statement. The financial statement. The statements about owner's equity simply shows the beginning balance, the net income, cash dividend, stock dividend. This will be discussed later. The statements of changes in equity disclose the significant information about the equity that is not presented separately elsewhere in the financial statements and the useful to the external users in understanding the nature of changes in the equities account. Then we go to the meaning of the statements of changes in owner's equity is otherwise called as retained earning. The statements of changes in owner's equity is otherwise called retained earning. What is retained earning? The retained earning are the portions of the business profit. Retained earning are the portions of business profits that are not distributed as a dividend to the shareholders' interest. To the shareholders' interest. But instead are reserved for reinvestments back into the business. The retained earnings are the business profits that are not distributed to the shareholders as a dividend, but it will be reserved for the reinvestment back into the business. Normally, these funds are used for working capital and the fixed asset purchase, or allotted for paying off debt of the obligations. How we calculate retained earning? Actually, we calculate retained earning first taking the beginning period of retained earning plus net income or loss, then subtract the cash dividend, then subtract the stock dividend. Okay, these are the meaning of retained earning. Then going to the next slide, statements of changes in financial position. Statements of changes in financial position. The statements of changes in financial position are the consisting of the statements of changes in financial position are the consisting of two statements. One is funds flow statements, another one is cash flow statements. Okay, the funds flow statement means the changes of funds. When we prepare funds flow statements, the funds flow statement means the inward and outward movement of funds of an enterprises. The inward and the outward of the funds. The the purpose of funds refers to the working capital and the flow means movement. The changes of working capital. The changes of working capital is called funds flow statement. Therefore, the flows of funds means movement or the changes in the working capital. This will be helpful in the financial statements. In the next slide, The financial statements contain all the details of the financial resources which have become available during an accounting period. The statement discloses the amount raised from the various sources of financing during the period. It explains that how finance has been used in the business. In the particular period, how the changes of finance or changes of funds, these are to be discussed in the financial statements. Then combinations of fund flow and cash flow. What is cash flow? The cash flow also referred to the changes of a case. It is the changes of a case. It is the one of the three key financial statements that report the cash generated and spent during a specific period of a time, the month or quarterly or the year. In the particular year, what is the changes of case? In the particular period, what is the changes of a case? These are to be taken when we prepare the cash flow statement. The statement of a cash flow statement, the statement of a cash flow affect the bridge between the income statement and the balance sheet. That's showing how money moved in out of the business. In the particular business, the changes of a cash is to be provided by the cash flow statement. I hope you understand the today's lecture. The today's lecture we discuss the objective of the financial statements and the types of a financial statement. If for getting more video, then like, subscribe and comment. Thank you. Bye.